I've studied and traded the futures markets for years, and here's what I've learned. Every futures market has its own personality. In this video, I'm not just gonna break down the basics of chart analysis, but the unique moves and quirks of each futures market. So by the end of this video, you can have a clear understanding of how to analyze these futures markets and charts based on what the candlesticks are doing. And even if you already know some of that basics, understanding how these futures markets actually trade and differ from each other in practice will completely change how you actually trade and your performance when it comes to trading. And so when it comes to trading, a lot of times you start out thinking that I need, 10 different indicators on my chart and all these different things that make it easy to, know what to do, because it seems like an indicator can just tell you what to do. But at the end of the day, if you learn to just do some of these basic chart analysis things, you will drastically improve your trading. And one of those is just learning to look at the major swing highs and swing lows of a market. It will drastically improve your understanding of the direction of the overall trend. And when it comes to actually entering in trades, the biggest factor I always take into consideration, no matter how good the more smaller patterns look, is the overall big picture of what the market is doing, because that is going to rule your trade no matter what. It doesn't matter how good a support level looks or a trend line looks. If it's coming to a major area and your big picture analysis of a trend is that it's overextended and it needs to slow down, well, if you, jump in short right here and you weren't looking at just that big picture, you're gonna be losing a lot more trades than you want. And so the basics of, downtrends and uptrends are made by the market making lower lows and lower highs, where just the swings are getting lower and lower. An uptrend is just a flip where it's making higher highs and higher lows. And this really helps you, just this basic structure helps you stay on the right side of the market of saying, okay, well, overall, this thing is mainly making lower lows and lower highs. There can be some times where, okay, it gets a little back and forth here, where it has right here, it had actually more of a quick uptrend before it continued its downtrend. So that could have just been a pullback in the major downtrend that was taking place. And this can also happen because what's happening is you're at a transition period where you are going from a downtrend where it's making consistent lower lows and lower highs, and then all of a sudden it starts making a higher low and then a higher high, and it shifts to an uptrend. So you're gonna have these areas, and these are really key to start to learn, is have areas where it starts to shift. And you want to be aware of that, because that's when the trend is starting to change. If you're either in a trade betting that it's going to go down, well, that's usually a signal to get out. Or if you're looking for the market to reverse to the upside, well, you can take that into account for going long and taking a reversal trade and trying to buy the bottom of the swing. And so a super helpful thing with identifying a lot of the swings in the market, and this is just going to take you time to understand, is going through, and you can use things like a trend line. And so how I like to draw trend lines is if I just use a quick drawing to kind of show you before we look at the charts, because no chart really looks like this. But a lot of the time what you want to do is you want to essentially just match the highs. The idea with the trend line is you're matching it to all the main swing highs that you're seeing. And then on the flip side, you can also make what's called a channel, where essentially it's both, where the market doesn't do this a lot of the time, but it can sometimes make a channel where on the upside, where the pullbacks, they will respect a downtrend, and then on the swing low side is they'll also basically be respecting a downwards trending support line. And this is a downwards trending resistance line. And so what those do is those essentially make a channel, and they make it really easy to identify what the market is doing. Now, because the market is always changing, now a clear kind of one is actually on a bigger time frame right now. This is the NASDAQ futures. So how you want to draw a trend line and start one is, you'll see here we're looking at the big swings here, and then it makes a high here, and then it starts to just trend lower. Now you're not gonna know these right away. It takes some time, and it usually takes at least 2 swings to be able to draw that trend line before knowing it could bounce off of it a 3rd time. And so I like to at least wait for 2 swings to draw it off of. And so here, there's this big swing up here and this swing right here. And so for me, I would take a drawing tool and start it at the swing high here and then draw touching this next one. And then so here you can see the market came up here and it didn't quite touch this if you put it to exactly the highs. But so that's the big thing about any tool or drawing tool you use in the market with support or resistance, trend lines, anything you use, take it with a grain of salt. You can have some flexibility in it. It's not gonna be, okay, well, it didn't touch my line exactly, so I'm not gonna, it didn't count, right? Think of it more of like a zone. This is a big thing I do, and we'll talk about it in a minute with my support or resistance levels, is I don't think of it like one line. I think of it as an area where, okay, well, the market will come up here somewhere and reverse lower. Versus this, it's a big line. I don't wait for it to come exactly up here. So if it's coming up here, I'm thinking, okay, well, it's close. And if a trade set up off of that, then I would take a trade off of it. And so once it finishes, well, then I'm going to adjust based on that, because I consider this to be a pretty clear touch and a reversal. And so going forwards, again, I would look at that and say, okay, well, extend this out and see what happens. And this is where trend lines and everything become very subjective, is you can match this either with the highs, or you can also drag it down here and say, well, there's all these bodies here. Well, if you do that, you can see that this got a lot closer here and made a lot more sense. And so that's where drawing tools can be a little tricky, or drawing trend lines can be a little tricky, is it can be very subjective, because you can see here, well, once we got down here and down here, is what pretty much was touching these ones as well. And so that's kind of how trend lines work. And so that's why we're drawing them. My kind of rule of thumb is take it with a grain of salt. It doesn't count as a break of the trend line if it, breaks by 1 candlestick and goes back in, or it has a wick that breaks above. A clean break of a trend line is where the candlesticks clearly break out here like this. And so kind of on the flip side, what that can look like, just to find you a quick example here, here's another, just moving back in the chart a little bit. Here's kind of a trend line right here I would consider. And you can see here, it's clearly broken that. And so at that point, I would say, hey, I think that this trend is over. The potential there means that it could either go sideways or it could reverse to the upside. And so from that point, you would use whatever other factors you're using, an analysis like support zone here, I already have drawn on the chart, or just looking at the big picture, where are the big swings in the market and kind of what's been going on. So at that point, it looks like, okay, yeah, it's kind of bouncing, and I would look for, kind of a move off of that. And so when it comes to practically using trend lines, they're going to be broken pretty quickly a lot of the time. And a good example was actually this morning in gold, where on actually a 1-minute chart here, is it had a really nice bottom here and a trend line up. And so the market just followed this for a while until it eventually broke. And so you can have multiple types of trend lines where they're really sharp here and just kind of very fast paced, or like that bigger picture downtrend one they were looking at. And even gold actually has one going on right now too, is zooming out to more of a bigger picture 15-minute chart. As you can see here, it's got this, it made a larger swing high right here, kind of a double top, and then it's had 2 clear swings here, and then the third one I think pretty clearly bounced off of that. And so another example here is on the flip side. You can see on the bottom end, I've drawn a swing off of these 2, and then there's this third one right here. And so it looks like it's clearly starting to bounce there, find some support. And so that's how you can start to use these as clearly predicting where the market could slow down and reverse. Now, one last one is, I call it a spike and channel, or a spike and trend, where a lot of times in a beginning of a move, the market right here, you can see it does a quick spike where it just moves very rapidly in one direction, and then it starts to slow down into more of a methodical trend. Now this one's still pretty tight here, but you can have it essentially on the flip side too, on an uptrend where it goes up and then it starts to go into more of a healthier trend. The market has a lot of different types of trends where, they're unhealthy moves like this, where they're likely to have a pullback or consolidation at some point, or more healthier moves where, like this, if we zoom out, where, it's slowly moving back and forth. And that's more of a range bound move. And when it comes to trading futures, I've always found it to be very important to stick to when there's more volatility in the market, because trading in, a choppy market, this is the NASDAQ yesterday on a 5-minute chart. This is the whole day of trading basically. And this is the first kind of 2 hours. And you can see it just sat here and did nothing. And so that's times where you kind of want to stay out and not watch the market too much, and save your money for a day where you have more volatility like this, where there's more moves that are more tradable. And so this is where time frames are really important to pay attention to. You can trade whatever time frame you want, but when it comes to futures, I highly recommend sticking to entering your trades on either a 1-minute chart or a 5-minute chart. And then bigger picture, you can look at, I like to look at a 15-minute chart or a 30-minute chart for kind of understanding the broader picture of what the market's doing, drawing these kind of bigger swing moves. And that really helps you understand the big picture of what's going on, because you can easily see, okay, based on just the swings of the market right here in gold, that it's pretty back and forth right now. It's kind of in this downwards tightening wedge that's going on. But just looking at this and not really analyzing it too much, you can think that, okay, well, just based on what it's been doing, it's kind of been going back and forth with some moves in between. And so when it makes this move, well, it's probably likely to move back up, because the market likes to just repeat what it's doing most of the time until obviously the trend kind of shifts. But when it's in this kind of back and forth mode, going into a larger time frame to see that and understand that is really important, because then you can go into a 1-minute like this or a 5-minute and enter your trades more accurately near the lows of that swing. And you could enter in right here betting that the market was going to go up, capture that swing, and you could get something like 4 times your risk in your profits. And so that's why timeframes are really important, and especially day trading and intraday trading, because when it comes to futures, intraday margin is very, very powerful. And the real reason why I think it's good to trade futures, if you're trying to swing trade futures, I think there's other better, safer assets to do that. But when it comes to day trading, futures are really, really powerful because of the low margin requirement that some brokers have. And so that's what I use when it comes to trading. I use a 1-minute and a 5-minute to enter, and a 15 and a 30 to analyze my charts. Now, before we jump into drawing support and resistance levels and candlestick patterns, I wanted to let you know about my free 90-day trader roadmap. It's going to give you a step-by-step plan that you can follow over the next 90 days to build your trading and accelerate the learning curve for you to become as good of a trader as fast as possible. You can download it for free using this QR code or the link in the description of this video. Now, when it comes to support and resistance levels, they're very, very similar to drawing these trend lines and channels. Switching over to a 15-minute chart here for gold, I do the same thing. You're again using that initial super basic foundational thing of where are the major swings in the market and looking at just combining those. And so here you can see here there's a ton of little swings right here that I would draw a zone off of. And what I like to do is I like to have at least 2 clear swings, and then I like to draw the bottom of the box off of the extreme low, and then the top of the box, again, this is subjective and you'll just get better at this over time, but is taking into account essentially where other bottoms of the market was. And so you can see one example here is, well, this bottom happened all the way up here, but after getting kind of this data right here, I would only draw it basically at this point. I wouldn't have it all the way up here because you don't want your zone where you're looking for the market to bounce to be too big. I find the best way to trade, especially off of support or resistance zones, is waiting for the market to hit the extremes. That's why I actually don't look at, okay, well, you know, there's a couple swings here. I could draw a resistance zone here. You totally can. And you can draw something, you know, off of this guy right here and this guy right here. The key is those are less likely to actually work out. I find that, and you know, what I would update to now is as the market's kind of adjusting here, is kind of these swings right here, because these are clear swings in the market where it's bottom. It's kind of a wide zone at this point. And so with this swing we actually had this morning, this spike here, I would again adjust it and try and move it down here to say, well, okay, the market's bounced here, but those were the extreme bounces. And when you're looking for reversal trades, sticking to the extremes is very, very powerful because you're able to catch the market when it's overextended to one direction, and you'll often get a snap back from that. Now, I don't know if it's gonna happen here because if you look, we had that already this morning. And this is where that snapback is very powerful, is the market snapped down here with a lot of momentum and then had a strong reversal off of that. And it came to this resistance or support level that was already, I think, in place from these two swings here. And so this is very powerful for just a simple trading strategy of waiting for the market to get to extremes, having a drastic move, and then looking for it to bottom off of that because it's overextended in an unhealthy way. Just to show you a couple more examples here, here's some other levels I've drawn. Sometimes you'll have the market open where in this day it had some smaller swings. And when I'm intraday trading, the market opened right here. I'm thinking, okay, these are the overnight levels that it had. I think that it's likely to bounce between these before it breaks out in a big way. And so sometimes what you can do is you can use this to see where a quick spike higher can be. And because this is on a 15-minute chart, on a 1-minute chart, what this would look like, it would look like more like this, a spike higher, and then a big reversal lower. And so you can use that to catch essentially the top of the market and catch a big rip down. And so you can start to use just these simple trend lines and swing analysis and then support and resistance to see what the potential is to happen for a lot of these markets. You can say, okay, well here there was this uptrend in place. The market was going sideways here. It broke this uptrend this morning and then hit this resistance level. Well, that's a pretty good signal that the market could reverse. And that's the whole idea of technical analysis, is just using the basic structure of the market. Now, where you can get in trouble is over analyzing. And that's why I like to stick to where it's just super clear and really obvious what's going on, and staying out of insanely choppy times like this. The market, the last couple of days here, you can see these are the opening days, and then this is kind of the overnight movement. Every day here, the NASDAQ here has pretty much just done nothing. There's times in the market where you'll have movements that are just terrible for trading. Every strategy has market conditions that are crappy. My strategy is more of a reversal strategy of taking trades off of either big trend lines and looking for a move down, or off of, you know, good support lines and looking for moves up off of those. But any time that the market is just sitting here chopping like this, and you can even go to a 1-minute chart. Today had some good movement for the first time, but if I zoom in on this day, you can see it's just back and forth. If you zoom in, it looks like maybe there's some good movement, but big picture again, there's really, really little movement to capture. Or continuation markets are terrible when the market is in more of a range bound or reversal volatile market. And so that's why it's really important for you to understand what markets are good to trade in and what aren't. And the biggest one again is choppy markets, and just learning to understand and read, okay, well, when is there a big movement and volatility, that's when you want to start paying attention and looking for potential trades. It doesn't have to be necessarily looking for reversals. It could be looking for continuations if you think the trend is really strong. Again, that's why you look at the big picture and say, okay, what do I think is happening? And if we look at and analyze this, well, the market was in a big downtrend and then it started to have this support level. Well, I think when it breaks this support level, it's had all this consolidation, which is really healthy for the market. And so once it breaks, it's very likely to have a large move in that direction because it's broken this support level. It's not overextended. It's unlikely to fake lower and continue higher, because also looking to the left side of the chart, there isn't great support levels to look at. It had a kind of a pretty strong trend up. And so big picture, this trend could be reversing and having a pullback before, it does whatever it's going to do next. And that's where if you wondered what this would be doing next on a bigger picture, you could zoom out even more to, let's say, like a 60-minute chart or even a daily chart. And that's where, ignore all the random little drawing time frames because those are incorrect. We're on a daily chart right now. But, looking at a daily chart, this is where I would think, okay, we're in a clear big uptrend. We might be having a bit of a pullback here, but I'm assuming we're in an uptrend until we have a clear pullback and a double top and something's starting to fail here. And that's where time frames are really important to understand. Of just because on a daily chart right here the Nasdaq is in an uptrend doesn't mean that if I go to a 5-minute chart or a 1-minute chart, I'm not going to be looking for a short on a shorter period time frame. You can still be looking for shorts and longs. It just depends on what time frame you're looking at and what those time frames are telling you about the market. And so what's really important and helpful is understanding just basic candlestick patterns. What these will do for you is, once you kind of understand how to read markets, you don't really need these, but it's a good cheat sheet when you're first starting. Because if we look at this, here is a descending triangle, and it's basically saying, okay, the market has a horizontal support with a downwards trend line, and the trend into it was a downtrend. And so once it breaks this to the downside, this support, it's saying it's likely to continue lower. And if we look at our NASDAQ chart, well, you can see we pretty much had a downwards descending triangle right here where it had that support level and then a downwards trend line. And then once it broke that, it had a really big move lower. And so that's a really good way to use these and match them up with what's going on to help you understand when you're starting to learn these as a beginner. And so when it comes to actual candlestick patterns as well, these can really help you break down some smaller patterns of what could potentially be happening right at these inflection points. Now, these are all reversal patterns. Once you kind of understand what they mean, it really makes a lot of sense. And so, for instance, here, this one, it's a V reversal because you have a trend coming down quickly, and then you have a hammer candlestick pattern where the market essentially just goes like this in that one candlestick, and then big picture, it continues higher. This candlestick pattern, essentially on a smaller time frame, what I'm drawing here is it essentially just makes a double top. And a double top is a larger, bigger picture structure reversal pattern. And these ones right here they are a momentum switch where the market is going down, in this case really methodically, and starts to slow down. And then you have a massive switch in momentum. And so going through this will really help you understand how these can work. And another one is essentially consolidation, where the market either here it has it in a form of just a doji, or here it has it in the form of multiple candlesticks where it has a downtrend, it starts to just go sideways, and then it moves up. And so this is also something you can get if you get that 90-day trader roadmap. It'll just be emailed to you as well. And it's really something that is, I think, really helpful for understanding candlestick patterns. Now I want to jump into the personalities of these major markets. What I trade the most is the NASDAQ futures, the S&P 500 futures, gold futures, and oil futures. And these all four have different personalities and how they react to a lot of these patterns that we've gone over. They will react differently to them, respect them in a different way, which makes it really important to actually practically trading these, because when it comes to looking at a move like this on gold here, I'm gonna approach it differently than a move like that on the ES or the NASDAQ. And so first I wanna go over the ES futures, and the major things that I think about it is, I think one, it's great for beginners because it's very methodical and a lot more predictable. I think the moves in the S&P 500 futures are a lot more solid. It doesn't have as many fake outs in one direction. It's not likely to spike one way and then go the other as often. Take everything with a grain of salt. Of course, you can have, a spike like this and then a reversal, but it's not gonna be as volatile as something like the NASDAQ. And so the NASDAQ, one thing about it is it's more volatile compared to the ES. If you look at the NASDAQ in the first 30 minutes here, or let's just say an hour, it was pretty volatile. And if we look at the ES in the first hour, just to adjust here, it was more volatile, but it wasn't as all over the place. The moves were a little different. And what this shows me is that it helps me realize, and I think as a beginning trader, if you're watching the ES here, instead you will realize that, okay, it's more choppy, it's back and forth, the market's not really sure what it wants to do. And then when it has more of a breakout in one direction, you can see that, okay, that is a stronger move, and you can make a decision if you think that's an actual solid breakout or it's a failed breakout, versus the NASDAQ was having moves all over the place very fast. These candlesticks right here are huge, and that can be a lot harder to trade in. Now, obviously the NASDAQ and the ES are very correlated most of the time. Sometimes you'll have the ES where it's more choppy and the NASDAQ is more movement. And so that's mainly the only main difference between the two in terms of direction. The NASDAQ could be doing something like it's selling off because it's, more tech focused, where the S&P 500 futures could be actually moving up or just kind of going sideways. And I think if you're looking to trade just one, which I think is the better way to start out, because trying to look at both can be a little confusing, I would stick to the ES futures because they are more likely to not fake you out and give you a better directional movement. Now, when it comes to respecting trend lines and levels, I have found that the NASDAQ and the S&P 500 futures will sometimes break a trend line after the move has already started. So what I mean by that is, let's say we have a trend line right here. Well, I will sometimes see that if we're coming down to a support level here, the entry to jump in the trade is before the signal of it breaking the downtrend. Now, I don't always do this. I would say if you're a beginner, don't do that. Wait until it breaks the downtrend clearly, because again, that's always a very obvious confirmation. But there's times where the market can move really fast and it makes sense to jump in before it actually breaks that downtrend. But in that case, I'm using it with the idea that I think, based on what I'm seeing, it's gonna break that downtrend. Now, when it comes to gold, I have noticed that gold is way more methodical and respects its trend lines more than the S&P 500 future and the NASDAQ. It had this trend line right here, and I would not take a trade to the long side, big picture, until it broke this downtrend. Now, on a smaller time frame, you totally could jump in on a long here like this guy, because the idea is, well, if you jump in long here, let's say on this pullback, you're gonna be in the profit before it hits where it likely reverses here. But like for this, if you were in a trade long right here, betting that the market was gonna go up and you were making money as this goes up, as soon as this breaks this trend line, I'm gonna get out of the trade, because likely with gold that it's gonna either start going sideways or go down, or maybe it'll continue going up, but the trend is over that I wanna be following. Same thing down here, is it had a really strong trend this morning after that kind of move. And then once it broke that, my thought was, okay, well, it might reverse or it might go sideways. And again, looking at other factors, I didn't actually think that this was gonna go up, because you can see the bigger picture is coming into play and pushing this thing down. Also with gold, I have found that a lot of the time entering in on a 5-minute chart is actually better than a 1-minute chart. Now, the only time I do, just because again, it's more methodical and slow moving. Now, when it has some volatility, like it had this morning, like this move right here, and you would know that the volatility is happening because these candlesticks here are showing you that the volatility is happening. And then so when it starts to bounce here, I would jump in somewhere right here on this pullback and bet the market was gonna go up because it's had that volatility, and I can get a trade signal based on that. And same thing here, but you know, for other reasons I'm not gonna jump into too much, I would think jumping in there on a 1 minute or a 5 minute would make sense. And so kind of on that note, going back to the ES and the NASDAQ though, I think you can trade both. Again, some of that is always gonna be personal preference. A 1 minute chart is always gonna be more fast paced, more intense, and more likely to trigger your impulses and have you, jump in on a trade when maybe you shouldn't yet, where a 5 minute is always gonna have slower, more methodical, stronger signals. But I think you can kind of do both. What I like to do is I like to do a 1 minute for generally my, I like to trade and look for reversals in kind of the first 30 minutes. And I like to use a 1 minute for that because a 5 minute is a little too slow for a lot of the whipsaws and movements that happen in that time period. Now, the last one here is oil futures. And oil is a lot trickier than these other markets, I think. Now, I probably take a trade in oil once every few weeks or even months, because a lot of the time it's very kind of choppy and back and forth, and then it can have just a big move out of nowhere. And what that's from is it's because it's very news driven. Is you can see if we go on a 1 minute chart here, looking at this, you can see that it's moving almost nothing. Is because of how the candlesticks look here. It's even gapping between each one of these lines is a tick, which is, the smallest movement a futures market can have. And so oil, just based on these candles, you can see that it just looks super, super choppy, and it's just not moving at all really today. And so even on a 5 minute, you can see that, okay, well, it's still pretty choppy. It's having some kind of methodical moves, but most of the time, it's just not really doing much. Now, if I look at a 1 minute chart, yesterday, it did have a decent little spike lower. Now, actually, I think it's set up on a 5 minute chart better. And so that's where, sometimes a 5 minute is a little better. And it doesn't mean just because on a 1 minute it's choppy, it doesn't necessarily mean it's bad to take a trade on a 5 minute. But you can see here, it had a little spike lower, came to actually a support level, and then started to bounce. And you could have kind of caught this initial spike and then maybe this trend higher. But it's a lot trickier, and I very rarely take trades in it because they don't set up very often. But when they do, they're good trades. That's why I like to watch it and keep track, because it can still have really good moves. Now, if you're still new to futures and trading and my strategy, check out this video right here. I'll go way more in depth on how I actually use this technical analysis to approach trading futures consistently every day.